All right, this is about retirement income planning in this volatile and uncertain time. And this is a very, very turbulent time. And this is agent training materials. So we have to use it for prospecting, not prospecting client, but recruitings and agent training use only. So before we go on to the product itself, I'll show you the basic principle of this kind of product. It's called annual reset. What annual reset will do is that when the market goes up, when the stock market goes up, it'll go up along with the stock market. But because of the hedging mechanism that we have, it will not go up as high as a stock market. But it'll go up according to what stock is doing. If stock is going so much, it'll go up, but not as much, but it'll go up so much, right? When the market goes down, when the stock market goes down, it'll stay still. It will not come down. And then wait a year or two, whatever the segment may be, when the stock market goes back up, it'll go back up. When the stock market goes down, it'll stay where it is. It's called annual reset. What annual reset will do is two things. Number one, annual reset with a minimum interest rate of 0% floor guarantees that you will never lose your principal. Your original investment will be intact, even if the market is going down, 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 down every year when you have the policy. You'll never lose your original contribution. That's one thing. But that's not the only thing. Another thing that's happening with annual reset is this. Let's say 1 year it went up 10%. And next year stock went down 20%. What happened to the 10%? It stays still. So what the annual reset does for the second thing is this. The gain that you have retained previously will not be lost. No matter what happened, you will have your original contribution, same amount. It will not lose your original contribution. And not only that, as you're waiting, when there's a little bit of increase, whenever there is an increase, you will not lose that interest either. So that increase always will be there. So that's the type of thing that we're dealing with. So you will not get a high rate of return, but you'll have a decent rate of return, better than fixed rate. But what this will do is that it'll guarantee that you will not lose money, and it'll guarantee whenever you have a gain, the gain will not be lost. And not only that, if you put this kind of investment strategy into annuity, it makes a very, very beautiful product, because there is only one financial product that has guaranteed lifetime income. That's annuity. Guaranteed lifetime income can only be found in annuity. You may say Social Security. Social Security is a form of annuities. So only one product, only one financial product that gives you guaranteed lifetime income is an annuity. Now, annuity comes in 3 different forms: fixed, indexed, and variable annuity. Fixed annuity is just, you think of it as a bank account, the savings account. It has a declared interest rate, and that interest rate is set for a year or two, however the contract is written. So it pays the guaranteed fixed rate. What's the problem with the fixed rate? The interest rate is a little too low, but you have no worries about losing its value because there is a minimum guarantee interest rate. Now the other one is called variable annuity. Variable annuity is, they're putting their money in professional money managers who manages mutual funds. So what you're doing is that you're actually putting your money in the stock market. Guess what happened with the stock market? It has a very, very high growth potential. At the same time, it also has risk associated with it. So variable annuity, you can win money or you can lose money. So there is a risk. So on one hand, fixed, you have a guarantee, but interest rate is low. On the other hand, you have a variable who have a good growth potential, but there always a chance of losing your gain and your original principal. So what they've done is they come up with something in the middle. It's called indexed annuity. Indexed annuity is this. They don't pay you the guaranteed interest rate. What they pay you is that they have a certain formula to associate with it. Depending on what the index is doing, you get rate of return. But if that index, like S&P 500, is doing minus, it is actually losing its value, there always the minimum floor, and a lot of times the minimum floor is at 0. So if index is doing negative, you get 0. If index is doing positive, you get to participate in the positive gain in direct way. Let's say we have an index annuity that gives you 50% participation. And let's say the index S&P 500 it is tied to S&P 500. Let's say S&P 500 did a 20% gain. If index annuity saying that we'll give you 50% of that index, then you get, instead of 20%, you get 10%. What if S&P 5 did, instead of 20%, negative 20%? You're not getting negative 10%. Because the minimum floor is 0. You get 0%. So in that way, what you will see is that you will not get as high of growth potential as an index, the stock market. But then again, you will never have to worry about losing its value because the minimum that you're going to get is a 0%. Remember annual reset? That's what it is. So we're putting this type of, there are many of these products and they made it a lot of enhancement on this. And I'm going to show you a few examples of these enhancements. All right. Very first one, this is one of the many companies that we're dealing with. This particular one guarantees 7% a year growth for 10 years. This is, somebody asked me this morning, is that 7% compound interest? Yes, it is a 7% compound interest. If you put $200,000, it guarantees, if you look at the guarantee contract assumption, guarantee is the worst case scenario in life insurance and annuity. In the guarantee assumption, that $200,000 after 10 years will be $393,000. No matter what happened to the market. This is a guarantee. There's a catch to it because that $393,000 you cannot get it in one lump sum, but what you're getting is that with that $393,000, the insurance company will calculate how much lifetime income you're going to get. In this particular example that I posted to you, this person started at age 59. He has a $200,000 contributed into this account. He waited 10 years. After 10 years, he can take out $21,245.23 guarantee for the rest of his life. $21,000 is guaranteed income for the rest of his life. Even if $393,000 is gone. Even if there is no more money in his account, because this is a guarantee written on the contract, the client is getting $21,245.23 from age 70 until he passed away. Now, what if after he took out the first $21,000, he dies? If this client dies, as you can see, there's a death benefit of $173,000. That $173,000 will go to the beneficiary that he named. So that's the minimum guarantee of 7% a year for 10 years. That's the product. I mean, I'm pretty sure most of you can think of the company and product. All right. Next one is that some people are asking, okay, so lifetime income is good, but what about inflation? What if I want my income to increase and I want the product that has increasing income option? This is one of the many products that we have. This one is the same thing. This one is not guaranteed, by the way. This is actually last 10 years, but it is guaranteed that you will not lose money. With last 10 years historical performance, your $200,000 is now $443,000. And from that $443,000, you can take out at age 70, 23,956. You can see that right here, right? 23,956. Now, after he got this money, year later, we noticed that stock, the index that crediting that method he has increased 2.35%. Now what you'll see is the money that he's going to receive will increase by that much. Now instead of 23,000, he will receive 24,494, and this is set. After this event, he will not get anything less than 24,494. Once again, annual reset. Once it goes up, it never comes down. So look at this one. This one at this particular one at age 77, he will get $33,000. And next year, because of the 14.6%, he get 35,000. Right? Now that year, stock did a minus, but minus means zero in our product. So what's going to happen is that the retirement income that he was getting will be remained at $35,026. That's what's happening. See, what you will see is this. At age 70, when he first drew income, he had a 23,000. At age 83, 84, that income is now 46,367. This is the type of product that we have. Increasing lifetime income. These two are not the same product. So what we need to do is we need to decide, or not decide, we need to talk with the client what he likes to have. If the client wants 7% guarantee, no matter what happens, maybe we'll go with the first product. If the client likes, hey, I want the potential of growing bigger and bigger every year, this is a product. Now let's go to the next. Here's another one. This one gives you 5% premium bonus for 7 years. This is the people who do not have $200,000, who do not have $100,000 to begin with, but they're building their nest egg. This particular product, you can put as little as $100 a month. What this will do is that they'll give you, on the first 7 years, whenever you put the money in, this company will pitch in 5% for you. There's a premium bonus of 5% for first 7 years. First year he put $10,000. Immediately his account will grow $500, and then whatever the index is growing. So this is the past 11 years of growth potential. So you'll see how this is going, and this is a good product for people who are building their wealth. Instead of, this is more of retirement funding, retirement planning section side of the story. They're saving for retirement. On the other one, the other two we talked about is we start out with a lump sum. So we're looking at retirement income management. There are two different design aspects as we're doing this. All right. And the next percent that I got lots of money, but this is tied into some stiff surrender charges, and I want to have a bonus. This is for big money, up to 15% bonus. In California, 15% bonus is not available. In California, because of the way it is set up with the Department of Insurance, in California, maximum you can get is 7%. But in other states, you can get as much as a 15%. So it depends on where you are, you can have this benefit. So what I have decided to do is that we're going to go each of this illustration together in next few weeks. We'll go through the illustration to show this how this planner are in how we can actually design this plan and show it to our clients. So these are the type of thing we can do, right? So we have many products and we can actually help out people even in the midst of this chaos, even in the midst of this very dreadful, difficult stock market situation. We can actually set the plan that guarantees lifetime income, right? So how we can help to plan for retirement? Number one, we can help to avoid losses. Product that I'm teaching you how to teaching you guys, it has no loss associated with it. There is no loss. Minimize fees and expenses. There is no fees. And tax, if it is a qualified plan, we can get tax deduction as we're contributing. And either qualified plan or non-qualified plan, as money grows, the growth is also tax-free. I think correct term is tax defer. You don't pay tax until you take the money out. And when you take the money out, you don't get taxed on the entire amount. You only get taxed on the amount of money that you're taking. Let's say even if you have you have accumulated $1 million, if you're only taking $50,000, you'll be taxed on $50,000, not $995,000, right? 950,000. All right. And guaranteed growth. I just showed you some of those guaranteed growth products. All right. And immediate bonuses. I showed you many bonus products. So those are the things that you can actually have. We can set it up on all of them. We can set up the guaranteed lifetime income. We can even set up the guaranteed growth. We can actually set up the income actually has an option of growing also. And that's the number 7, increasing lifetime income. We can all help out this client. And the thing that I'm saying to you as an agent is that, do you know how to help your clients? These are the things that we have. Things that I done today should just been a refresher. You should all know all this product. If you don't, next few weeks we're gonna go through with every individual product that I went over, and we're gonna do the illustration together, and we'll talk about, as we're doing the illustration, we'll talk about more details on this.